expect this bull market to have legs, which, like I was saying, these bull markets and flat markets for gold tend to be about a decade long. So, we might still be fairly early in this bull, because if they're no longer independent, that is going to be very bad for debt. It's going to be very good for gold.
Hey everybody, it is Chris Johnson with Monument Traders Live. I'm joined by Marc Lichtenfeld. I think if I point here, I should be pointing at him. Marc is the Chief Income Strategist with the Oxford Group. Marc, it is a pleasure to be with you. I've actually been excited for about the last, week or so, because I think we've all seen what gold has been doing. We're going to talk about gold a lot today. I've been, as everybody I think has for the last 2 or 3 years, gold has been that hot trade, and I kind of want to drill down to the reason why and make myself feel better about what's happened. A 20% correction or an 18% correction just a couple weeks ago. I want to hit all of that and talk about some of the exciting things that you've been looking at, whether it's central banks buying, how it affects everybody's long-term income portfolio. And I use that because you are the chief income strategist, but I'm really, we'll call it the hidden tax, and how concerned we should be about hard asset portfolios, specifically gold. Say something. I'm taking the whole stage. How you doing today?
I'm doing great. It's great to be with you. And I'm excited to talk about gold, because it's not something I normally talk about. We haven't worked together very long, but those of you in the audience who know me know that I'm not one of these guys who's a perma bull when it comes to gold. I haven't been talking about gold for the last 30 years, and I'm finally right. It's something that I'm excited about now, but historically never have been. So I'm excited to get in and talk about it.
It's funny you mentioned perma bulls, and I think that everybody thinks there's been this permanent rally in gold forever. I can remember my college days. I had Professor Paul Swanson, not Simon. He did bigger things, but Paul Swanson was a gold perma bull. I mean, he was one of those guys. It was a finance 203 or 204. And all he talked about were the gold models and how this was going to be his retirement plan. Last I heard, he was still teaching at the University of Cincinnati at the graduate level. But he's probably feeling pretty good about gold. Let's give me your one line. What's the most interesting thing about gold for Marc Lichtman right now? Lichtenfeld, sorry. What's the one thing? Like, you wake up in the morning and gold is blank.
Well, I think there are two things. I think gold is a place you want to be right now because of some very, very large shifts in the world. On the one hand, you can look at a stock chart and say, okay, there's a lot of momentum behind it, and for a trader, that's great. But the larger picture is you've got a weakening dollar that is probably not going to strengthen much more. I mean, it's gonna move, it's gonna bounce here and there, but the dollar is falling, and it's likely to stay that way for the foreseeable future. And just as importantly, you have countries around the world are selling their dollars and buying gold. And I don't see that changing anytime soon. So you have these very large forces out there that are very bullish for gold.
Wow. I mean, that's let's take a piece of that right now. Let's kind of step into, I want to separate this into thinking about gold as a trade and thinking of gold as an investment, which I think is what you're kind of alluding to right now. There's more on the horizon is what it sounds like. You mentioned central banks. You mentioned the weakening dollar, which I think we have seen, what's going to happen, or at least we're balancing right now on a long-term bear market with the dollar, right? I think everybody's accepted that this is going to happen. We're going to see the dollar go lower. When you separate all of that, one of the things that I start to worry about, and I think a lot of people watching today, I'm going to voice what they think, that is that gold has turned into a little bit of a meme trade of late. And what I mean by that is everybody sees, let's use the Main Street. I always like to take a look down Main Street. When you see people going to the Costco and they're selling out of the coins as soon as they get them in. That kind of
Mm.
says there's a feeding frenzy out there that might be a little euphoria. You're saying it's not the case, right?
Yeah, I don't think we're at the point of euphoria yet. There's certainly a strong interest in gold. There's no doubt about it. As you pointed out, you go to Costco and they can't keep their coins in inventory. But I would point towards silver as being a little bit more of that meme trade, and because that's gone absolutely insane, and the moves both up and down are much more exaggerated than in gold, and historically that's always been the case. Silver, it can be very, very volatile, whereas gold, we're certainly seeing a historic bull market right now, but we've seen other big moves in gold before that didn't feel as tenuous. With silver, it kind of feels like every day you turn on your computer, anything could happen.
Okay.
It could be up 5-10% a day in this particular move. Gold doesn't feel that volatile to me. It's certainly moving quite a bit, but it doesn't feel like that to me, at least. And I think that's because of some of the things I mentioned earlier, that there are some very strong uh, global forces that are behind this move.
Okay. Let's let's get to that in a second, because that's, I think, is the most interesting. That's the rub, as they say. When we're looking at this right now, or the rest of the story is Paul Harvey. I don't. Does anybody even remember who Paul Harvey is? Do you know who
Sure,
Paul
I
Harvey
remember
is?
Paul Harvey. Absolutely.
What? I lost you for a second there.
I was just saying I remember Paul Harvey for
Okay.
sure.
Yeah. The rest of the story, as they
Yeah,
used to say. So let's try to encapsulate what we've seen here in the last month. We saw that frenzy, and you just nailed it. Silver was the one. It went from 80 to 100 to 105 and just kept going. And then all of a sudden, it didn't. And we saw it pull back 40%. We saw gold pull back 16, 18% or so. So what you're saying is silver is more of the meme trade here. And I think that stands to be true. Why would you? We think of precious metals as being hard assets. If you're going to buy gold, you're going to buy silver, you're going to, you can buy platinum, you can buy all of these things. Um, if we look at that silver trade and what happened, 40% pullback, is that just a trader's metal right now when you look at silver?
that's a great question. I think it's both. I think there are some very sound fundamentals behind silver. I think precious metals in general are a place that you do want to be. And silver is also an industrial metal,
Right.
so there's some real fundamental reasons to own silver. But I do think that the volatility and the trading has kind of gotten a bit away from those fundamentals, and when you're seeing these gigantic moves, it's a little bit hard to, I don't know, I guess, take it seriously as a store of value, at least in the very short term. Long term, I think it is a store of value, but short term, I think it's just a little bit too difficult when it's bouncing so much every single day. I mean,
Yeah.
every day you turn on your computer and it's a 5% move is kind of common right now.
Yeah, I'm looking at it right now. SLV, if you're just looking at the ETF, is up 4% right now, 3.98, and you've got gold up a half percent or so.
Yeah,
I mean, you've kind of got that memification, or I always like to say volatility. Traders love volatility. I mean, if you're a
sure.
trader, investors tend to hate it because it makes them nauseous. They lose sight of the horizon. But short-term volatility, true traders love volatility. That's how you get paid. I don't care if you're going long and you're getting the volatility, the upside, or you're short and you're getting into the downside. Volatility pays you. Let's switch to gold because, as I mentioned, I think it was 16% from those
Mm.
highs. And when you look at that chart of gold, I mean, if we just start, and I'll pull up my chart here very quickly, but when you start to look at what gold has done, um, let's say over the last 2 months, Mark, this has been a parabolic climb. This has not
Mm.
been a historically calm move, right?
Yeah, absolutely. It's been moving much faster than it has in the past. Though, I mean, if you do look at, I think it was, and I'll be able to see it when you bring up the chart. But there's in the 2006 to about 2011 bull market, there was a period where gold doubled. I want to say in about 2 years, and right now it's gold has doubled faster than that, but it hasn't been, 2 months. So it's certainly been faster than we've seen in history. But keep in mind also, we don't have a lot of instances to go by. I mean, the last 50 years, there's been what, 3 bull markets in gold? You had coming out of the dot-com boom. Um, it's there haven't been too many things where you can look and say, well, historically, gold does this, because historically, gold has just stayed flat for a decade, then it rises for a decade, then stays flat for another decade. So to say, well, 16% is that normal? It's a little bit difficult to say. Is it a big move down? Of course it is. Is it historically abnormal? I would say perhaps not. I mean, in the I think it was around 2007 when gold came in a little bit. It dropped. I think it was about 24%.
Mm-hmm.
There was another instance where it dropped about 30%, all within a bull market. So 16% is not the end of the world in a bull market, especially if you expect this bull market to have legs, which, like I was saying, these bull markets and flat markets for gold tend to be about a decade long. So, we might still be fairly early in this bull market.
Yeah. I mean, if you're talking a decade, you could argue that we took off in what, 2021, right around 2021, 2022. And I
Mm-hmm.
think, and if, man, this chart is just insanely parabolic. I've got 5 years right there. Here's your 20-year view. So right in here at that 2021, 2022, we kind of lit the match. We had inflation going. We had the dollar coming down. We had a lot of things, right? A little uncertainty in the market at that time. We had geopolitical events and we had geopolitical risks. But for this to have taken off and gone from 2,000 to 5,000, and it's clearly caught Wall Street on its heels, because the analysts out there, I think when we were at 2,000 or even 2,500, they were saying, maybe we'll go to 3,000. Maybe we'll go. And then we started to see those adjustments come in, which always tells you that you're on the right end of the trend there when you see Wall Street trying to catch up. But this is, let me switch this to a 50-year chart. And this will be mind-boggling. So there is your, and call it, and this isn't log adjusted, but call it a little bit of a malaise here, from 1985, 86, all the way up through that 2000 point, the dot-com bubble you mentioned. So this rally went 11 years that we saw from 2000 to 2011. You're thinking that, what, a break above this 2000 that we did in 24, that was the unleashing of this market, and that would put us 2 or 3 years in the middle of it? Is that correct?
Exactly. Yeah. So, we're about 3-ish years into this bull market. And like we were saying, historically, these trends for gold last a lot longer than that. So that, we should be in a prolonged bull market. Doesn't mean that we're not going to have pullbacks, and it could be even worse than 16% along the way. But I think if you check back with us in 2030, 2032, we're going to see gold a lot higher than it is now. And, as you said, the last time gold went from 2,000 to 3,000, nobody saw it going further than that. Right. A lot of times when you have these strong bull markets or bear markets on the other side, prices tend to move a lot more than people expect. And that's certainly true. We've all held stocks, sold them when we've had a really nice gain, only to see them continue to go higher. Because at the time you thought, well, how much higher is this going to go? I already have a 100% gain, 200% gain. I mean, how many people sold out of NVIDIA with really large gains, only to see it, go up exponentially more? So I think that's going to be a similar situation for gold, where 5 years down the road, 7 years, we're going to be at much higher levels than we are right now.
All right, Mike Mack or Mike MC just asked the question I'm going to get to here in a little while here. The best way to own or invest gold. Just give me, I'll ask you for some hints. I don't want you to give away the farm, as they say. Let's go back to that, looking at the horizon, because that's clearly what you're doing with another 6, 7, 8 years worth of rally that we could have here. You're saying that this is a full-on structure of, it's a structural, but it's not a short cycle market. What, if you had to put three things, and maybe you want to expand that. You can say, hey, CJ, I need a bonus or two. But what are those fundamental underpinnings of that long term look? When you look out on the horizon, you see gold that could continue to go, just chug along. What are the three big things that are at the top of your list that say, this is what I'm looking at? This is why I believe this?
Yeah. So most importantly is the weak dollar,
Okay.
and it's not just a matter of, oh, the dollar is in a bear market, it's trending lower. The president of the United States has made it very clear he wants a weak dollar. Now his staff has come out and say, no, we have a strong dollar policy. They don't. Uh, the president has said very clearly he wants a weak dollar. Strong dollar really only sounds good. A weak dollar means your exports increase. It means it's cheaper for foreigners to come to the United States as tourists. It means it's more expensive for Americans to go overseas, so maybe they spend their vacation dollars in the United States. It helps the economy, and especially with those exports, which is certainly what the president wants. And so, like I said, he's made it extremely clear he wants a weak dollar. Doesn't like to necessarily use the word weak because it sounds,
Weak.
it's the word weak, but
Right.
that's what it is. He wants the dollar lower for sure, and more than any other president that I can remember, he has emphatically stated that. So that is likely to continue. And then along with that, you also have countries that are selling their dollars in favor of gold. And we're seeing that for a number of reasons. One is that the United States has weaponized the dollar,
Mm-hmm.
where certain countries like Russia don't have access to their dollars the way that they used to. The United States seizes certain dollar denominated assets, doesn't give them access to banking. Not just Russia, there's some other countries. And so not only those countries, but then the rest of the world sees this and says, well, maybe we need to diversify a little bit and get out of the dollar. And so you see countries, not just China and Russia, but you see countries like Poland are selling their dollars and buying tons and tons of gold. And in fact, central banks around the world for the last 2 years, there's only been 1 month where they've sold more gold than they bought. And that 1 month, it was barely, they barely sold it more than they bought. Every other month, they've been buying more gold than they've been selling. And so you've got around the world, central banks are accumulating gold. A number of big important countries are selling dollars. So that's really, two of the main forces that I see. And then within the United States, you do have inflation. The president would like to think, and he stated it yesterday, that prices are going lower. I don't know too many people who would agree with him on that front. Life is getting quite expensive for everyone in almost every facet of their lives, and so I don't see inflation being tamed anytime soon, especially if you have a dovish Fed chair. Now, historically, he's been hawkish, but he's been appointed by the president, and I'm sure he didn't take the job to become cannon fodder and be yelled at by the president every month. So I'm sure he's going to do his best to keep interest rates low, which should only spark inflation. And historically, gold is a place you want to be in inflationary times. So there's a lot going on for gold right now, and a lot of reasons to think that this bull market should continue for a number of years.
I'm going to unpack a couple of those things real quickly. And I put this up on the screen. I happened to trip upon this yesterday. It's from the Brookings Institute, and they talk about
Hmm.
the central banks buying gold right now. Let's talk about that for just a second. You mentioned, I thought Poland. Poland was number 3 on this list, along with Russia, as you mentioned, and China. China's
Hmm.
been dumping debt as well, or let's say divesting from our debt. And when you look at this, is this, I mean, you talk about a bigger problem or a bigger something out there on the horizon. I think everybody's talked about, the United States or the dollar possibly at some point losing its currency reserve status. Is this why they are loading up on gold right now? Is there something else underneath the skin, so to speak?
That's a great question. I mean, we know that China would like to have the dollar not be the reserve currency anymore, and have their currency be at least a reserve currency, if not the reserve currency. I'm not as worried about the dollar losing its reserve currency status, at least in the short to intermediate term. I mean, maybe 20, 30 years from now, who knows?
Okay.
But within the next 10 years, that's not something I'm particularly worried about. But the fact that other countries are buying more gold, selling dollars, I don't think it's because of a reserve currency issue. I think, like I was saying, they want to just diversify and make sure that, give the United States perhaps a little less power over them, to hold up their funds, to weaponize the dollar as they have been. So I'm not too worried about the reserve currency status for a while. We've been hearing that for years and years. Maybe someday that comes to fruition. I don't know, but it's not something I'm really worried about. It's kind of these other things, and just the idea that these countries are selling dollars to buy gold. Keep in mind they're obviously not dumping all their dollars.
No.
They still will hold lots and lots of dollars, but they are moving the needle. I think that the statistic that I saw was something like 10 years ago, 68% of the world's central bank reserves were in the dollar. Now it's 57%. So they are slowly moving away from the dollar, and that's a lot of dollars to be selling year after year after year, just to move at a percentage or two.
Right.
So I do think that will continue.
All right. How about the Fed? You suggested, obviously, somebody stepping in front of the cannon fodder there. How much of an impact, and we've seen a lot of uncertainty around the Fed over the last 6 months. We went from a Fed that was going to drop rates 3 times in 2026, maybe even 4 times, to all of a sudden scratching around for maybe 1 or 2 drops. Jerome Powell, whether you like him or not, whether you want him to stay or not, he's going to be gone in May, right? Or at least he will not be in his current position. All
Right.
kinds of speculation about what could happen there. He could step, into a role on the board, but not leading the board, right? How much, let's say that we get right away a couple of interest rate cuts, which the administration would love right out of the
Mhm.
gate, because they've been very vocal about their disappointment with the Fed in lowering rates or not lowering rates. How much would that give you a nice little spark, another catalyst for that next leg up right now in gold?
Oh, for sure, because I think it would be very inflationary. I mean, when they were lowering rates, I think it was about 2 years ago, I wrote an open letter to the Fed basically saying, what are you doing?
Oh,
You're cutting rates and we are seeing no slowdown in inflation. Obviously, inflation had come down from those sky high levels of 2021, but it was still way too high. And I think we're still at that point where we're not close to that 2% inflation rate. If we get to the Fed's target at 2% and they want to cut rates, hey, I'll tip my hat to them and say, job well done, and do what you have to do. But we're not there. And so the idea of cutting rates, to me at this point, is ludicrous. And like I said, would spark inflation, which would be bullish for gold. So I certainly hope that they don't cut rates anytime soon, unless the data shows that they should. It really needs to be data dependent, not political dependent, not just anyone's opinion that rates should be lower. It should be that the data can support it, and it won't result in higher prices for Americans in all walks of life.
let's put on our conspiracy hat for just a second here, or I'm going to. And first of all, I was smiling because I have a friend that wrote an open letter to the Procter and Gamble board, and it's fun to have somebody that's written an open letter to the Federal
They didn't
Reserve,
respond
the
either.
Federal Open,
I was
the
very disappointed.
FOMC. You didn't get anything back. Nothing.
Nothing.
Come on. I mean,
No.
just send them a
Actually,
note
no.
back.
Actually, that's not true. I did get a form email saying, thank you for your input.
Okay.
But I'm pretty sure nobody. I don't think Jerome Powell read it and considered it,
He didn't pull out the
even
stationery
though he should have.
and jot something down to you. It's just fun. It's fun that you did that. I love that. And that kind of tells people how serious you are about what you're watching here. I mean, to sit and put, I joke about it. I have cards that, say, hey, note that I sent you a card, not a text message, to my friends, for birthdays and stuff like that.
Mm.
But for somebody to put that kind of thought into what we're talking about today and actually take action to voice their concerns to the Fed is amazing. And I hope people I'm not trying to stroke you a little bit here and say, hey, this is great, but it really is good. I mean, it tells me the level to which you've been looking at this. Um, if the Fed, and this is where I put my aluminum hat on for just a second. Um, if the Fed, and we don't know, who is going to get confirmed, et cetera, when, but if we do see that, I don't know what to call it, control being expressed by the administration. And
Mhm.
I don't know that it blatantly needs to be the president himself, but let's say that we do see a Fed that starts to bend, not break, and starts to go along with some of those wins, those strong trade wins
Mhm.
right now. Does that affect people, the way they look at the dollar, the way that they look at our debt? And then the follow up to that immediately, as you probably know where I'm going, is what does that in and of itself do to the price of gold or silver or hard assets at that time
Right.
seem like they become incredibly critical, right?
Yeah, and I think that would be a very, very strong argument for hard assets and gold, because if the Fed is perceived as bending to the will of the president, that's you know that's some toothpaste that's going to be hard to put back in the tube. And when President Trump leaves office, um, there'll be another president at some point, whether it's Republican or Democrat. And think about it, especially if it's a Democrat. Um, if the same rules apply for Trump, the same rules are going to apply for whoever's in office. And if it's a Democrat, they tend to have different fiscal outlooks than
Sure.
many Republicans. And I think you would see basically a Democrat is going to do the same thing that President Trump did. Any president will. If President Trump is able to influence the Fed, every president going forward will, and they're all going to want lower interest rates, which should be very, very inflationary, and a very strong argument for gold. So I think it's a very dangerous precedent. Look, I'm not somebody who is super impressed with the Fed. I have been very critical of them for years. They always overdo it, whether they're raising or lowering interest rates, and they stick to their guns for too long.
Hmm.
But the fact that they are independent is meaningful. And the minute that they're no longer independent becomes a real big problem.
Okay.
So I think it's something you need to watch closely, because if they're no longer independent, that is going to be very bad for debt. It's going to be very good for gold. It's going to be bad for inflation. It's going to be a problem.
Okay. So, and I've got something I want to ask. Somebody we both know sent me, something about the auditor, and I want to ask you about that. So kind of cue that up in your head here, because it's one of those there's a little mystery here. But
Mm-hmm.
looking over the next 5 to 10 years, do you see gold as the number one thing right now? I mean, is this a complete are we going to look at gold differently? Are we in the process of seeing gold in a new light? Put whatever pun you want on it. Is there? You just said something about toothpaste coming out of the tube. Genie in the bottle. Is this no turning back moment for gold? I mean, this is where gold really becomes something that's much, much, much bigger than anybody's guessing.
Um, so I'm going to put words in your mouth and say, are you asking me if this time it's different? Which if that's the case, I'm because that's kind of the way I'm hearing it, and I'm always hesitant to agree with that sentiment. But would the scenario I just described be extremely bullish for gold? Yes. Does that mean it's going to be strong forever? That's a very difficult question to answer, and I feel like I can't answer that more than, let's say, 5-7 years down the road. But I think certainly in the near term, it changes the way people look at gold. Will it be the number one thing to own over the next 5-7 years? Also, tough question to answer. I think it's something you will definitely want to own. And look, the Oxford Club always recommends that you have at least 5% of your portfolio in gold, just because it's a non-correlated asset.
Right.
Whatever the market's going to do in the short to intermediate term has really almost no bearing on gold. So that's one reason to own gold, regardless of all the other things we've been talking about. But should some of these things come to light, and gold is very strong. Look, I'm bullish on the market long term also, but things happen, and certainly in the short and intermediate term. So I think you really do want to own gold in this time period, because at some point, probably in the next 5 to 7 years, we will hit a bear market in the stock market, no doubt about it.
Oh yeah.
I'm not bearish. I'm not calling for a crash. Nothing like that. Bear markets happen, and they happen with some regularity. So owning gold, especially if you kind of believe in it the way we've been talking today, seems to make all the sense in the world to have an asset that is likely to appreciate at some point when the market is falling.
Okay. SP put up something about the, this. I mean, you're going to do a live session on this next week on the 4th, and there's obviously an invitation for everybody to sign up. What will somebody miss out on if they're not looking at gold the way you are right now? What's the thing out there? I mean, I'm proud of being here because we work with individual investors that are on top of things. I mean, this is one of those groups that kind of feeds off of itself. The Oxford group, with Monument Traders. I mean, it's a different level our people are operating at. So I like to think that they're going to uncover most of the stuff that we're going to uncover. But what are they missing? What's in front of their face that you're going to be able to go through and actually tell somebody, hey, you're not watching this? I mean, you wrote a letter to the Fed. Are you going to I'm going to hang up on that for a while. But what is the information right now that the normal person that is just holding a position in gold or might have a little bit of a position in gold, what's their blind spot?
Yeah, well, it's I think the most effective way to invest in gold, and that's what we're going to be talking about on March 4th. And there's a very specific way to invest in gold that really leverages the move in gold, and can help investors take advantage of this for not a lot of money. To buy an ounce of gold costs you about $5,000 these days. You don't have to put anything close to that into the way we're talking about it. But it also is. It's not the first thing to move when gold prices soar, and we've already seen gold prices soar, but it's generally the next thing to move. So I think this category is going to be the next. You showed that gold chart before that was kind of going straight up over the last couple of years. I think this next category is going to be the next chart that looks like that. So that's what we're going to be talking about, and the reasons why this particular area of gold is going to work so well.
And everybody loves an idea to go along with that. You're obviously going to position that as well, give them an idea of how to leverage it.
And like I said, some of these investments are very, very inexpensive. So even if you don't have a ton of money to put into it, even if you just want a little bit of exposure, you can do it for a few hundred, even a few $1,000s, if that's all you want to put into it. And just so at least that way you have some exposure into this particular type of asset.
All right, I'm curious. I'm definitely I'm curious myself. Let's dig back in, and I like to. And by the way, everybody should be signing up for this. I mean, I think we're sharpening our swords every week here. And this is one of those areas right now that I look at. Let's just put it this way, Mark. You've already said it. Somebody bought NVIDIA when it was down in the teens, or let's say they bought NVIDIA when it was a video card company, right? Or when they were getting into the automotive industry or whatever, and they never sold it until it went haywire, and they sold it, and they have that fear of missing out. That's kind of the position I'm in. As long as I've been doing this, and I've been investing since the 80s, the late 80s. Gosh, yeah. Since I was the guy in high school that had the Barron's Encyclopedia of Investing. So I was the nerd. But I have never felt, I shouldn't say I haven't ever felt, but I've felt like gold's at that point where it's going to take a lot more to push it up the hill. We're starting to lose a little bit of that driver of gold's back, and now it's got to be an approving point. And you're saying there are proving points that are out there that are still uncovered, right? Or haven't been uncovered.
Well, I don't know if it's that they haven't been uncovered, but I think these forces are going to continue.
Okay.
Like I was saying, that the weakening dollar, the central banks around the world, I don't see any let up there. So well, first of all, I don't know if the mainstream investor really knows about these things, how much that's being covered in the mainstream press. I mean, Barron's recently did something on the dollar, on the weakening dollar, but for the most part, I don't think the average investor who looks at their 401k statement once a quarter is thinking about this. So it's I don't know if it's super mainstream, but like you said, this is not a hidden corner of the market anymore. Gold, people are paying attention to gold, no doubt about it. But that doesn't mean it can't continue to go higher. So if you are not in gold now, you're certainly not getting in at the bottom if you get in now. But you don't have to be. One of the things that I do as a technical analyst is I'm never in at the bottom.
Right.
Calling a bottom is incredibly difficult. Almost nobody can do it. Nobody can do it twice, that's for
Yeah,
sure.
you get one.
So I don't worry about trying to call a bottom. I try to get into whether they're stocks, commodities, whatever I'm investing in. I'm trying to get into something that's on its way up. And yes, gold has had a pretty big move so far. But if you believe, as I do, that there's a lot more where that came from, who cares if you're getting in now? If 5 years from now it could be double, or who knows where it could be from now. As I think it was a Greenspan said, markets have the ability to stay irrational longer than people can stay solvent. I'm butchering the phrase, but
Oh,
basically
that,
meaning markets move a lot farther than you ever expect that they will. So
yeah, that goes back beyond Greenspan days, actually.
oh, okay. I was thinking of rational exuberance. Yeah.
There's a great, yeah, he was irrational exuberance. Markets can remain irrational longer than you can remain solvent. That's
Yeah,
what the
that's
saying
that's what it
was,
is.
and that
But yeah,
was
so the basic point is you don't have to be in at the bottom. You can catch a move in the middle. And if we are in, let's say, a 10-year bull market for gold, and we're 3-4 years in, there's a lot of runway left. So that's kind of another reason that I'm excited about gold. You can look at various markets. You look at a typical stock market, a bull market. They go for a few years, then there's a correction or a bear market, which usually only lasts a year to a year and a half on average, and then there's another bull market for a few years. But like we were saying, gold has these very long phases where when it moves for many years.
okay. Is there a risk? And I always like to look. I mentioned blindside. Is there a risk of somebody who doesn't take a look at what you're looking at right now and start to consider either that 5% or different ways to play gold? And specifically, I'm thinking about when I talk about risk, and it's good, chief income strategist. I mean, you are the guy that talks about income portfolios and such. When I think about weakening dollar, when I think about inflation, when I think about all the different things that we've talked about, I can have a portfolio that returns, 7, 8% or so, but my buying power is getting depleted at that point, right? I
Right.
mean, I'm not preserving as I say, preserving my wealth. I'm just putting up a number that may not mean as much next year as it did this year, correct?
Exactly, and that's one of the reasons that in when it comes to dividends, I'm always talking about dividend growth, because you want to increase your buying power. When I wrote my book, Get Rich with Dividends, the first edition in 2012, inflation was non-existent at that point and was for many years, and I was really harping on that: increase your buying power, increase your buying power. That's what the dividend growth will do. So yeah, I do think that is important. Gold is a very different animal in that there's not a ton of gold stocks that generate meaningful yields. I mean, you've got Barrick at over 3%. I don't think there's too many others really. So, gold is a very different animal. But like you were saying, there's ways of preserving and improving your buying power. You could own Nvidia and watch that stock go through the roof, assuming that continues,
Right.
or you can own other assets that are strong in multi-year bull markets that will also boost your buying power. Won't if you own gold bars, that's not going to increase your income, but it will increase your wealth, and eventually you can turn that into the cash that you need to buy the goods and services that you need to live on.
Let me go off gold for just a second. And because I am interested in very much that when you think about the US dollar and income portfolios, is now the time to be diversifying income portfolios? I mean, we talk about what's the, 60/40. Back when I was
Hmm.
an advisor and a stockbroker, 60/40, 60/40, 60/40. It feels like the 60/40 is kind of dying on the vine a little bit here, or at least it's not doing the job that it did back in the 90s, early 2000s. Um, are you modifying your income approach, including gold, including what you'll talk about next week? Are you modifying your holistic approach here so that you can adjust to what's going on, with bonds? I mean, you can get, I always look at bonds in some cases, and I think investors get that warm, blanky feel, from, hey, I own bonds that are
Hmm.
yielding 5% or 4%. Well, yeah, but if you're, losing some of that principal because the bond market is having credit problems, or we've got a lot of debt out there right now, it's a false sense of security sometimes. It sounds like gold is right now not giving you that false sense of security. Am I correct when I say it that way?
Correct. Yeah. So, yeah, gold doesn't give me a false sense of security in that. Again, I believe we're in a multi-year bull market. It's a long-term store of value. I will say I'm not too worried about bonds. I mean, yes, if you own a bond with a 5% coupon and there's inflation, that coupon is fixed. That income is
Right.
fixed. On the other hand, bonds, if you're buying, especially investment grade bonds, and you're choosy, I'm not too worried about the risk. I think the risk is in some other parts of the market. So I do think bonds deserve a place in your portfolio. Probably not 60, not 40%, as you were mentioning, for a lot of people, unless you're very risk averse and you just want to protect that principal, and not worried kind of about too much growth or too much income. But I'm not worried about bonds other than perhaps a little bit of these hiccups we're seeing in software and some of these companies that have, we're seeing some of the AI companies moving things off balance sheet. That kind of stuff worries me. But if you're talking about your general investment grade corporations, I'm not too worried about that at all. But I agree that 60/40 doesn't work anymore for most people because you do need that growth. And especially if inflation is not going to be under control the way it was back in the 2010s, then you need that buying power to increase, and bonds, won't do that for you.
No.
So you do have to weigh the safety versus the other things you're trying to achieve in your portfolio. But like we always talk about the Oxford Club, there you should be diversified. You should have some bonds. You should have some gold. You should have international stocks, again, to diversify away from the dollar a little bit. You should definitely have a good chunk of stock. So there are places in your portfolio for all of those things, and it's just a matter of how you're going to weight them depending on your tolerance for risk, depending on what your goals are.
There's a simple question, and I'm sorry I got a little distracted. I always like to watch the chat to see if I can pull out some questions. Someone's asking, how do you play bonds? Yeah, or how do you buy bonds? You call your broker, right? I mean, you let them, in the most cases, do the research, or someone like yourself do the research and figure out what bond is appropriate, the yield, the term, the length, et cetera, et cetera. How long?
Exactly. So there are bond funds. I've never been a fan of bond funds because if interest rates when interest rates go up, bond prices go down.
Right.
And if you own an individual bond, you don't care about the price going down because you're planning on holding it to maturity, where you're going to get your $1,000 per bond back. So you buy a bond, let's say at $1,000. There are some problems with the company. Interest rates go up. Now this bond is worth $900. Doesn't matter because at maturity, you're getting $1,000 unless they go bankrupt. That's a whole nother thing. But
Yeah.
if you're buying investment grade bonds, that's probably not going to happen. That's very rare. So we don't care about the price of the bond once we buy it for the most part. If you own a bond fund, those funds don't mature at $1,000 like an individual. So when you go to sell it, it'll be worth whatever it happens to be worth that day. And so if interest rates are up, the price of those bonds goes down, and the price of that bond fund goes down, and you may lose money.
Yeah.
So for the most part, I am not a fan of bond funds unless you are darn sure rates are going down. And even then, you still don't know exactly what you're going to get on a day that you may need the money. Whereas an individual bond, you know exactly what it will be worth on the day it matures, and then you can count on that money and then plan accordingly.
Yeah.
So you just call your broker, you go online, they list their bonds. You can screen for only investment grade, you can screen for treasuries, what have you, and then you click and buy them. And if you have any questions, you can call their fixed income desk, and they'll be happy to explain it to you.
Yeah, I love the view on bond funds. We got pinched, and this is back with an advisory that we had. Um, we got pinched by redemption risk with a very, very, very large investment company's bond fund, uh, to the point where we called them one night at like 10 o'clock at night and actually got a call back. And they said, hey, we're having to sell bonds that we don't want to sell
Wow.
because we've got so many redemptions coming in. And this is
Yeah.
back in the wake of 2009, 2010, everything that fell out there. But it was a scary moment because everybody does feel like, hey, a bond fund could be the great way to go. I'm just going to buy this and hold it, and they're going to do all the work. Well, if everybody runs for the door at the same time, they only have a certain amount of cash on hand, and they have to go out and sell it, figure out a way to raise the cash for the redemptions. It was one of the
And
oddest questions or oddest situations I think I was in the
yeah.
business to hear a
And that's
company like
exactly
that.
what's happening with Blue Owl, which if anyone has been following it, it's been, one of the reasons some of the Mag 7 stocks have been falling
Mhm.
is Blue Owl has private credit, funds, and they were starting to see redemptions, which meant they had to start selling bonds. So they've shut the door on the redemptions, and that triggered a panic for some people who are worried about the credit worthiness of some of these bonds. But yeah, that's kind of a similar situation when everybody runs from the door and you're in a fund. That can be a problem if you own the individual bond, as long as the company is relatively healthy and they're going to pay back at maturity, which for the most part, they're, if they're going to keep their lights on, they're paying back the bond at maturity for the most part, and especially investment grade bonds. I mean, their default rate is a fraction of 1%. So, if you're staying pretty safe in that level of a bond, it just doesn't matter if people are selling the bonds, if there's a big fund, that has to dump them. You'll just get your money back at maturity when it's over. So only buy a bond, though, if you plan on owning it till maturity. You can always sell it early, but only buy it if you plan on holding it to maturity.
Right, right. Good advice. Sage advice. All right. So now I'm going to mix in gold and the income. So when
Mhm.
you talk about gold, you're not just talking about, you've already made it clear, you're not talking about the physical asset, the hard asset. You can own that. It's going to preserve wealth or to help to build wealth. But
Mhm.
you've got income ideas around gold as well, correct?
There are some, like I said, there are not a ton of companies that pay a healthy dividend when it comes to gold.
Right.
So, like I said, Barrick I think is the highest yielding at about 3%. There's a few others. B2 Gold used to have a really nice dividend.
Yes.
It's come way down. There are a few others. So to me, gold is not so much that income producing idea. It's more of a either wealth preservation, if you're holding on to gold bars, and or in the case of where we are right now in a bull market, I think it will actually increase your wealth again, whether you're owning gold bars or you're leveraging some other assets in the stock market, and certain types of gold stocks that should perform even better than the price of the commodity itself. And so it's not so much about the income when I'm thinking about gold. It's really about growing your wealth and preserving it.
All right. I've got a couple questions from the Oxford group side here because we're streaming on both sides today.
Mhm.
Somebody's asking the question that I think everybody wants to know, and that is, what's the best way to invest in gold in your opinion, stocks or coins, or the approach that you're going to use next week?
So I prefer stocks
Okay.
because a stock, you can value a stock. There's all kinds of ways you can do it, based on PE ratios, based on discounted cash flows, all those things. There's a way of valuing gold. Is a little bit harder. It's what people are willing to pay for it. There's very sound fundamental reasons why it should go up or down, and we've discussed many of those today. But it's hard to say, well, gold at 5,000 is a bargain, but at 5,450, not so much. It doesn't quite work that way. Where you can look at a gold stock and say, well, this stock is trading at a lower PE than its peers, and it has a higher growth rate. Therefore, it's undervalued. This company has a leaner business model. It's much more efficient,
Hmm.
uh, way fewer capital expenditures than a giant miner. that kind of thing. So I do prefer gold stocks to just owning the physical metal. Also, a lot easier to store. You don't have to worry about having a vault or paying to store it somewhere, or even just, even if you own some coins, worrying about somebody in your house or whatever. Stocks are a lot easier for that reason. So I definitely prefer stocks. If you want to own some coins or some bars, I'm not totally against it, but I do like stocks as it's easier, and I think you'll make a lot more money owning gold stocks if you buy them the right way.
I like that view. Yeah, I do. Just so you know, I mean, you don't live around me. I put all the gold coins, the Cougaran, out in the Hill Brothers coffee can in the side yard. I just,
Nice.
yeah. There's a little rock on top of it, maybe a little garden gnome right next to it,
Uh,
that type of thing. So I know where to go. Someone asked, and this is a great question: the sanctions that we've seen, and the tariffs that we've seen, everything that's been going on geopolitically here. How do you see that as a factor or helping to price into gold over the next 5 years? Your outlook here. I mean, are these helpful because they add a little more geopolitical risk, or are they one of those things that are just a meh, as the kids say?
No, I think they are helpful to the price of gold for sure, because it's another reason why countries want to diversify away from the dollar, diversify away from doing business with the United States. So any kind of geopolitical uncertainty, anything that is, let's say, negative for the U.S. economy, for the dollar, I think is positive for gold. So I think it's definitely a contributing factor,
Let me.
no doubt about it.
I'm trying to pull this chart up one more time because the burning question that I mean, it's not even a burning question, but it's a yes or no from you, and not that you have to answer with a yes or no, but at 50, years old, as I said, I invested back in the 80s, the late 80s. Is this a once in a lifetime right now, even for somebody like myself? Is this literally like one of those things that people will, my finance 2.0 whatever professor, are those people going to point at this and say, man, that was it? I mean, that was the sweet spot on gold.
Well, I would say, we are in a bull market for gold.
Right.
Whether this becomes the epic bull market, the mother of all bull markets that we've ever seen in gold, it's a little, well, actually, it probably is the biggest bull market we've ever seen. Will it get even bigger? I do think so. Is it a once in a lifetime opportunity? It might depend on your age, because as we've been talking about, these cycles are very long.
Right.
So let's say this cycle ends, and I'm just picking a date. I don't, I don't have
Let me
a
get my
crystal
pen.
ball. Let's say this bull market ends in 2032. Well, then historically, you could probably assume another 10 years of gold being flat, and then perhaps in 2042, we get another bull market or what have you. So, if you miss this one, you may have some time to wait, and chances are you'll be buying it much higher. I doubt, in 2042, it's going to be back down to where it was if gold continues higher over the next 5 to 7 years. So is it a once in a lifetime opportunity? I guess it depends how old you are, but I do think it's a prime opportunity, and I think it's something you do not want to miss. I think you want to participate. And I'm not saying you have to back up the truck and sell everything, put everything into gold. Not at all. But I think you do need to participate in gold in some way in your portfolio. If you're not at all at this point, you definitely need to. And if you do have some gold, then you need to look at your portfolio and decide how much weight you do want to put into gold, into something that should be a strong bull market for quite a few years to come.
Yeah, Mike is saying what I'm thinking in the chat. I need a time machine to go back on these periods here and take advantage of it. I love that you're going to share
Well,
some
but again, my point is that these are long bull markets. So yes, would it be better to have bought it at 3,000? Absolutely. But and again, I'm just picking a number here. If it goes to 10,000, if it goes to 12,000, will you be happy that you bought it at 5? Absolutely. So that's one of the things that one of the reasons I'm so excited about gold. It's, yes, we have all these forces that we've talked about, these important fundamental factors that are, I believe, causing gold to go higher. but it's these long cycles. We're not trying to time the market and trying to see, well, our stochastics are turning higher and our RSI is oversold. And, we're talking what should be, a very long bull market. So if we didn't catch the bottom, it's not the end of the world. Anybody who bought NVIDIA, 2 years ago instead of 5 years ago is probably pretty happy.
Yeah, absolutely. Can AI replace gold? AI is replacing everything. And I don't know why I just thought of that question, but everybody's worried about AI replacing everything, our jobs, our day-to-day
Mhm.
routines, which, you know what, I'm still writing stuff on paper and with a pen every day. So I think I'm going to be behind the
Yeah,
curve on AI
me too.
taking over my lifestyle, but it can replace, I mean, there you go. Exactly. I mean, it is right here. And actually I had to use it as a mouse pad, but there's your legal pad. But and I guess I could also say, can Bitcoin, replace gold, which I think a lot of people think that Bitcoin can until we see a rout the way that we've seen for the last
Yeah.
2 months or so. But is there any threat there, or is that just a completely separate silo on its own?
I mean, certainly AI is going to have a profound effect on our economy down the road.
Hmm.
Does it replace gold? I don't see how it would. If anything, perhaps it lends more credence to the Bitcoin argument, but I'm also not somebody who is particularly bullish on crypto. I never have been. I honestly don't see the need for it. Everybody's, people. My argument against crypto is twofold. They keep moving the goalposts. They keep saying, well, it's a store of value. Well, it's not a store of value because it moves, 5-10% in a day sometimes. That's not a store of value. And it's not a currency. Nobody uses it for anything other than hackers and terrorists.
Right.
Um, so at this point, it is not. Whereas gold has firmly established itself as a store of value over the millennia. No, I mean that's you can't argue against that. So I don't see a direct connection between AI and gold, which I actually think is a positive thing.
Yeah.
If anything, it's kind of this old world, this old relic of gold. I think still has value and will continue to have value regardless of AI and other technological advances.
Yeah, it's interesting. I hit a nerve because now we've got people in the chat talking about how AI could help gold mining, which I think would be true. I mean, if you
Yeah,
think about the
for sure.
technology, I look at farms now that are using AI
Mhm.
and doing all kinds of things to increase their yield and their production. That could be good, but
Yeah, that's
right
a
now,
really good point.
yeah, gold is still very much a scarce item, though. So,
Yeah.
and which is one of the reasons why I think Karim brought something up last week or the week before. When the price of silver goes through the roof, everybody just starts taking their silverware in and turning it in for silver. They're not doing the
Mhm.
same thing with their jewelry. There's a true scarcity
Yeah.
effect here with gold versus silver. All right, you have a question for me? I always like to ask somebody if they've anything you want to know or anything that is missing here is the bigger question.
Um, just this event on March 4th.
Yeah.
What I'm really excited about is we brought in the smartest gold guy I know. So as I mentioned at the beginning, I'm not a gold permabull. It's not something that I've spent my life, uh, you know, uh, you know, deep in the weeds on. I don't go visit gold miners. That's not what I do.
Okay.
Um, we brought in somebody who does that. When I had lunch with him several months ago, and he was talking about the projects that he visited and the CEO that he had lunch with, and all these things. And this guy is so connected.
Mm.
So I've been leaning on him, uh, for his guidance on where the best places to invest in gold are. And actually, after this event, about 24 hours, a little longer than 24 hours after that event, I'm going to give everybody a chance to get in first. I'm going to be committing my own capital to some of his recommendations. So that's one of the things I'm so excited about is that we partnered with someone who really knows his stuff and and looks at gold in a way that I never have. So he kind of enlightened me. I mean, I certainly know all the fundamental aspects of it, but he shined a light on certain areas, some things that I didn't know, and then, like I said, this way of investing in gold that I sort of was aware of, but really hadn't kind of honed in on. So I'm really excited to be putting my capital to work along with everybody else's afterwards. So I hope everyone will check it out because this guy is really, really smart and really knows what he's talking
And
about.
this is the auditor, correct? This is
Yeah,
the
we call him the auditor,
auditor.
and you'll understand why at the event because I mean he like I said he really digs deep into the fundamentals of gold and these companies as well.
Well, you said two things that I love. Closing it out. Number one, you've brought somebody in that can add to your bevy of research. I mean, and that's the smart investor. I mean, when you know that there's an opportunity, and maybe you have to bring somebody else. A lot of people like to think they can do it themselves, but George Bush was that kind of president where he just brought everybody in and said, "Hey, let's get the brightest minds on this." I love that, and I love the fact that you're going to put some of your own capital into it. That's always one of those signs that you want to listen to that person. I brought the window that everybody will see when they click on that link right above to save their spot for next week's session. Go ahead and click on it. It's free. You're obviously going to get a couple of ideas as well, and you get to hear about the auditor, which I think is really cool as well. Mark, this has been a good time. We're going to have to do this again, right?
Absolutely, I
Yeah.
can't wait. This was fantastic.
Maybe you can help me out with my letter to somebody next time I write one. Just because the Fed thing is really impressing me. I like that. All
Be
right,
happy to.
everyone. We'll be back next week. Mark, it's been a joy to have you on. I feel like I've learned a few things that I didn't know before I started the hour, which is always my goal, and I hope everybody else has as well. I'm going to wish everybody a great rest of their week, the best investing success. You got anything to say to close it out?
No, just want to thank everybody for being here, and hopefully we'll see you on March 4th with the auditor.
I'm sure they will. I'm sure they will. Click on the link above, sign up right now. You'll get reminders and everything so you don't miss it. Have a great week, everybody.